Hey everyone! Tonight we're diving into one of the most consequential financial decisions in history, a decision that changed money itself. On August 15, 1971, President Richard Nixon went on television and announced that the United States would temporarily suspend the convertibility of dollars into gold. That suspension was supposed to last 90 days. It's been 53 years, and the gold window has never reopened. What Nixon did that night wasn't just economic policy. It was the largest default in human history. The United States broke a promise it had made to every country in the world, a promise that was the foundation of the entire global monetary system since 1944. Picture this. It's Sunday evening, August 15th, 1971. Americans are watching television, maybe Bonanza or The Ed Sullivan Show. Suddenly, programming is interrupted for a special address by President Nixon. This is unusual. Presidents don't preempt Sunday night television unless something major is happening. Nixon appears on screen, looking serious. He announces a new economic policy to address rising inflation and protect American jobs. He's imposing wage and price controls. He's adding tariffs on imports, and almost as an afterthought, he's temporarily closing the gold window. Most Americans watching have no idea what that means, but in financial capitals around the world, bankers and finance ministers understand immediately. The United States has just torn up the Bretton Woods agreement. The dollar is no longer backed by gold. The entire post-war monetary system has ended in a single television address. Before we go deeper, drop a comment below. Where are you watching from, and what time is it for you right now? I want to see how far the story of 1971 reaches across the world. And if you've been following our series on how banks have shaped financial crises from 1914 through World War II, make sure you're subscribed. Because what Nixon did in 1971 was the direct result of a problem that started at Bretton Woods in 1944. And tonight we're going to show you exactly how it happened. To understand 1971, you need to understand what came before it. In our previous video about World War II and Bretton Woods, we showed you how American banks positioned themselves to dominate global finance. The key mechanism was making the dollar the world's reserve currency, backed by gold at $35 per ounce. Here's how the system was supposed to work. The United States would maintain large gold reserves at Fort Knox and the Federal Reserve. Other countries would peg their currencies to the dollar at fixed exchange rates. If a country needed to, they could exchange their dollars for gold at the guaranteed rate of $35 per ounce. This gave the dollar enormous power. Countries needed dollars for international trade, to buy oil, to settle debts. To get dollars, they had to export goods to America or borrow from American banks. The dollar became universal money, and whoever controlled the dollar controlled global commerce. But the system had a fatal flaw built into it from the beginning. The United States could print as many dollars as it wanted, but it couldn't create more gold. As long as foreign central banks didn't demand conversion, America could run the printing presses. But the moment they lost confidence and asked for gold, the game would end. In the 1950s and early 1960s, this worked fine. America had approximately 20,000 tons of gold, roughly 70% of all monetary gold in the world. Foreign central banks held dollars and didn't ask for conversion because the dollar was considered as good as gold. But by the mid-1960s, the mathematics started breaking down. The United States was spending far more abroad than it was earning. The Vietnam War required massive military expenditures. President Lyndon Johnson's Great Society programs required massive domestic spending. America was trying to finance both guns and butter simultaneously. To pay for all this spending, the United States printed dollars. Lots of dollars. Those dollars flowed overseas to pay for war supplies, to fund military bases, to support foreign governments. Foreign central banks accumulated these dollars in their reserves. By 1965, foreign central banks held more dollars than the United States had gold to redeem them. Think about what that means. If every country that held dollars showed up at the Federal Reserve and asked for their gold, the United States couldn't pay. The promise backing the entire system was already broken. It just hadn't been tested yet. Some countries started to notice. France, under President Charles de Gaulle, was particularly suspicious. De Gaulle had never liked American dominance of the international monetary system. He called it an exorbitant privilege, the ability to print money that the whole world had to accept. In 1965, France began converting its dollar reserves to gold. French ships would dock in New York Harbor, load up with gold bars and transport them back to Paris. Other European countries watched this carefully. If France didn't trust the dollar, maybe they shouldn't either. By 1968, the situation was becoming critical. Foreign central banks held approximately $40 billion, but the United States only had about $10 billion worth of gold at the official price. The ratio was 4-1. The promise was mathematically impossible to keep. The Federal Reserve and the Treasury Department were growing nervous. They created something called the gold pool, an agreement among central banks to coordinate gold sales and prevent private speculators from exploiting the gap between the official price and market price. But the gold pool was hemorrhaging gold, losing hundreds of tons trying to defend the $35 price. In March 1968, the gold pool collapsed. Private markets were allowed to trade gold at whatever price they wanted, while central banks would still use the $35 official price. This created a two-tier system that satisfied nobody and convinced everyone that the official price couldn't hold. Meanwhile, American inflation was accelerating. All those dollars being printed to fund Vietnam and the Great Society were reducing the dollar's purchasing power. Prices in the United States were rising 5 to 6% annually, well above the post-war average. Foreign central banks holding dollars were watching their reserves lose value in real terms. By 1970, the crisis was obvious to anyone paying attention. The United States was running massive balance of payments deficits, meaning more dollars flowing out than coming in. Foreign dollar holdings had grown to over 50 billion, while American gold reserves had fallen to barely 10 billion. The system was insolvent. European central banks were getting nervous. Germany's Bundesbank started converting dollars to gold. Switzerland did the same. Even Britain, America's closest ally, was quietly diversifying out of dollars. The run on American gold was accelerating. Nixon's economic advisors knew they had a problem. Paul Volcker, then Undersecretary for Monetary Affairs, warned that the gold window might have to close. Treasury Secretary John Connally told Nixon bluntly that the Bretton Woods system was dead. They just had to decide how to bury it. But closing the gold window meant breaking a promise the United States had made to every country in the world. It meant defaulting on an obligation that was the foundation of international trust. It would be seen as America putting its own interests above its commitments, which is exactly what it was. Nixon was reluctant at first. He understood the political implications, both domestic and international. But by August 1971, he had no choice. Foreign central banks were demanding gold faster than the United States could deliver. Within months, the gold reserves would be gone, and America would face the humiliation of being unable to honor its obligations. So Nixon and his advisors planned a surprise announcement. They would close the gold window on a weekend when markets were closed and foreign governments couldn't react immediately. They would present it as temporary, a 90-day suspension to deal with speculators. And they would wrap it in patriotic language about protecting American workers from foreign currency manipulation. On Friday, August 13, 1971, Nixon gathered his top economic advisors at Camp David. Paul Volcker, John Connally, Federal Reserve Chairman Arthur Burns, and a handful of others. They spent the weekend finalizing the plan. No one told foreign governments. No one told Congress. No one told the American public. On Sunday evening, August 15th, Nixon went on television. He announced what he called the new economic policy: wage and price controls to fight inflation, tariffs on imports to protect jobs, and the temporary suspension of dollar convertibility to gold. The announcement was carefully crafted to make it sound like America was the victim, being attacked by speculators and unfair trading partners. Most Americans didn't understand what had just happened. The wage and price controls got more attention than the gold window closing. But in financial capitals around the world, the reaction was immediate and severe. The United States had just defaulted on its obligations. The Bretton Woods system was dead. When markets opened on Monday, chaos erupted. Currency markets didn't know how to price anything without fixed exchange rates. Stock markets fell as investors tried to figure out what this meant. Gold prices started climbing as people realized the official $35 price was fiction. Foreign governments were furious. They'd been holding dollars based on America's promise to convert them to gold. That promise was now worthless. France called it a betrayal. Britain said it was a unilateral American decision that violated international agreements. Even Germany, usually supportive of American policy, expressed shock and disappointment. But here's what you need to understand. Nixon's decision wasn't made in a vacuum. It was the inevitable result of choices made decades earlier. Choices that gave banks and the US government the power to print unlimited dollars while claiming they were backed by gold. If this is opening your eyes to how money really works, do me a solid. Hit that like button if you're seeing the pattern for the first time. And subscribe because we're exposing the financial history they don't teach you. Your support keeps this content alive. Let's talk about what closing the gold window actually meant for you, for ordinary people around the world. Because this wasn't just an abstract financial policy. It changed the nature of money itself. Before August 15, 1971, dollars were redeemable for gold. That meant there was a limit to how many dollars could exist. You couldn't print unlimited dollars because eventually someone would ask for gold and expose that you'd printed more than you could redeem. The gold standard imposed discipline. After August 15th, 1971, dollars were backed by nothing except the promise of the US government. There was no limit to how many could be created, no mechanism to prevent infinite printing. Money became pure fiat, accepted because governments said it had value, not because it was redeemable for anything real. Think about what this means for your savings. Before 1971, a dollar saved was a dollar that represented a fixed amount of gold. Its value was anchored to something real. After 1971, a dollar saved was just paper, and its value depended entirely on how many other dollars the government decided to print. The purchasing power of the dollar has fallen by approximately 85% since 1971. What cost $1 in 1971 costs about $7 today. This isn't an accident or a natural phenomenon. It's the direct result of removing the constraint that gold imposed on money creation. But here's where it gets interesting. Removing the gold standard wasn't a bug in the system. It was the goal. Banks and governments wanted the ability to create unlimited money. The gold standard prevented that. So when the opportunity came, they abandoned it. Remember what we covered in our World War I video. Banks in 1914 suspended the gold standard temporarily to finance the war. That temporary suspension in most countries lasted until 1925 or later. The pattern was established. Use crisis to abandon constraints, then never restore them. In 1933, Franklin Roosevelt confiscated gold from American citizens, making it illegal to own monetary gold. He devalued the dollar from about $20 per ounce to $35 per ounce. This was a 41% devaluation, a massive wealth transfer from dollar holders to the government. In 1944 at Bretton Woods, the gold standard was partially restored, but only for foreign central banks. American citizens still couldn't own gold or redeem dollars for it. The system was designed to maintain the appearance of gold backing while preventing anyone except governments from testing that backing. And in 1971, even that limited gold backing was removed. The progression was clear. 1914, temporary suspension. 1933, confiscation from citizens. 1944, limited to central banks only. 1971, ended completely. Each step removed more constraints on money creation. Now let's talk about what happened after the gold window closed. Nixon said the suspension was temporary, 90 days to deal with currency speculators. But there was never any intention of reopening. How do I know? Because the actions taken after August 1971 made reopening impossible. In December 1971, the Smithsonian Agreement tried to create a new system of fixed exchange rates without gold backing. It failed within 18 months. Countries couldn't maintain the fixed rates because the fundamental problem, American dollar creation exceeding economic growth, hadn't been solved. By 1973, the world had moved to floating exchange rates. Currencies traded against each other based on market forces, or more accurately, based on how much each country's central bank was printing. It was a race to the bottom, each country devaluing to gain export advantages. But the United States retained one massive advantage. Even without gold backing, the dollar remained the world's reserve currency. Why? Because of oil. And this is where the story connects to geopolitics in a way most people never understand. In 1973 and 1974, while the world was adjusting to floating currencies, the United States made a deal with Saudi Arabia. The Saudis would sell oil only in dollars. In exchange, the United States would provide military protection and weapons. Other OPEC countries followed Saudi Arabia's lead. This created the petrodollar system. Every country that needed oil, which was every country, had to acquire dollars to buy it. Even though the dollar was no longer backed by gold, it was now backed by oil, the most essential commodity in the modern economy. And behind the oil backing was American military power. The petrodollar system gave the United States the ability to print dollars that the whole world had to accept. Need oil, get dollars. How do you get dollars? Export goods to America or borrow from American banks. The system created permanent demand for dollars regardless of how many were printed. Think about the implications. The United States could run perpetual trade deficits, importing more than it exported. Other countries would accept dollars in payment because they needed those dollars to buy oil. Those dollars would then flow back into US Treasury bonds, financing American government spending. This was an extraordinary privilege, exactly what Charles de Gaulle had warned about. The United States could consume more than it produced, indefinitely, because the rest of the world was forced to accept dollars. And there was no constraint like gold to limit how many dollars could be created. The inflation that followed the end of the gold standard was severe. Throughout the 1970s, American inflation averaged 7 to 8% annually, reaching 13% in 1979. The purchasing power of wages fell. Savings were destroyed. People who had done everything right, saved their money, followed the rules, watched their wealth evaporate. But some groups benefited enormously. Banks and large corporations with debt saw the real value of their obligations shrink. If you owed $1 billion in 1971 and paid it back in 1981 after a decade of inflation, you were paying back dollars worth far less than what you borrowed. Inflation was a wealth transfer from creditors to debtors. Governments benefited too. The US national debt in 1971 was about $400 billion. By 1981, it was over $1 trillion. But because of inflation, that $1 trillion of debt was worth less in real terms than the $400 billion had been a decade earlier. The government inflated away the real value of its obligations. Who lost? Ordinary savers, wage earners, retirees on fixed pensions. Anyone who held cash or bonds denominated in dollars watched their wealth shrink while being told this was necessary economic policy. The loss was real, but it was diffused across millions of people, so no one organized effective opposition. By 1980, inflation had become such a political problem that something had to change. Paul Volcker, who had helped Nixon close the gold window, was now Federal Reserve chairman. He raised interest rates to nearly 20%, deliberately creating a recession to break inflation. The recession was brutal. Unemployment reached 10%. Businesses failed. The housing market collapsed. But inflation was finally tamed, falling from 13% to 3% by 1983. The pain was real, but it was necessary to restore some credibility to the dollar. But here's what's crucial to understand. The fundamental change Nixon made in 1971 was never reversed. The dollar never returned to gold backing. The constraint on money creation was never restored. The system remained fiat currency, backed by nothing except government promises and military power. And this connects directly to the crises we've covered in previous videos. In 1914, banks needed to suspend the gold standard temporarily to finance World War I. In 1933, Roosevelt confiscated gold to finance New Deal spending. In 1971, Nixon closed the gold window to finance Vietnam and the Great Society. Do you see the pattern? Every major crisis or expansion of government power requires abandoning monetary constraints. The gold standard limited what governments and banks could do. So, at each crisis point, they found reasons to weaken or eliminate it. Until finally, in 1971, it was gone completely. What happened in 1971 set the stage for everything that followed. The massive government debt explosion of the 1980s and beyond. The financial crisis of 2008, when the Federal Reserve could print trillions to rescue banks with no constraint. The COVID response in 2020, when the money supply grew 25% in a single year. None of this would have been possible under a gold standard. The gold standard would have forced discipline. The gold standard would have limited money creation to match economic growth. The gold standard would have prevented the massive wealth transfers we've seen from savers to debtors, from the public to banks, from the productive economy to financial speculation. Now let's connect this to where we are today. The system Nixon created in 1971 is still in place. The dollar is still fiat currency, backed by nothing except faith and military power. And that system is showing signs of strain. The national debt is now over $33 trillion, more than 80 times what it was when Nixon closed the gold window. The interest alone on that debt exceeds $1 trillion per year. There is no mathematically possible way to repay this debt, not without massive inflation. The Federal Reserve's balance sheet, which was about $60 billion in 1971, is now over $7 trillion. This represents assets the Fed has purchased by creating money from nothing, exactly what the gold standard was designed to prevent. And globally, countries are starting to move away from the dollar. China and Russia trade oil in yuan and rubles. The BRICS nations are discussing alternative payment systems. Saudi Arabia is accepting yuan for oil sales. The petrodollar system that supported the dollar after 1971 is beginning to crack. What happens when the world decides it doesn't need dollars anymore? What happens when the one thing backing the dollar, the requirement to use it for oil, disappears? The system that Nixon created in 1971 depends on continued faith that the dollar will be accepted. When that faith breaks, there's nothing underneath. This is why understanding 1971 matters. It's not ancient history. It's the foundation of the monetary system you live in right now. Every dollar in your bank account, every price you pay, every decision about saving or spending exists within the framework Nixon created. And here's what they don't tell you. The system was designed to benefit banks and governments at your expense. Banks can create unlimited credit, profiting from fees and interest. knowing the Federal Reserve will rescue them if they fail. Governments can spend unlimited amounts, financing wars and programs through money creation rather than honest taxation. The cost is paid through inflation, through the steady erosion of purchasing power, through the destruction of savings, through the transfer of wealth from ordinary people to those closest to the money creation spigot. This isn't a bug. This is the system working exactly as designed. Nixon didn't just close the gold window in 1971. He removed the last check on unlimited money creation. He gave banks and governments the power to extract wealth through inflation without limit. And he did it by breaking a promise the United States had made to the entire world. The temporary suspension announced in August 1971 became permanent. Just like the temporary suspension of the gold standard in 1914 became permanent. Just like every temporary emergency measure in financial history becomes permanent. Because once those in power gain the ability to create money without constraint, they never voluntarily give it up. So when you hear officials talk about the importance of the dollar, about maintaining faith in our currency, about the Federal Reserve's independence, remember what happened in 1971. Remember that the current system was created by breaking promises. Remember that it has no foundation except force and habit. Understanding this doesn't give you perfect protection from what's coming, but it gives you something more valuable. Context. When the next crisis hits, and it will, when you hear that the Federal Reserve is printing trillions again, when you watch your savings lose value through inflation, you'll understand it's not an accident. You'll recognize it as the system working exactly as it was designed to work since 1971. The system where banks profit, governments expand, and ordinary people pay through invisible inflation. History shows us that monetary systems based on nothing but promises eventually collapse. Rome debased its currency and fell. Weimar Germany printed without limit and destroyed itself. Every fiat currency in history has eventually failed. The dollar has lasted 53 years since Nixon closed the gold window. How much longer can a system built on broken promises and unlimited money creation continue? That's the question facing the world right now. The lesson of 1971 is that the rules can change overnight, that promises mean nothing when they become inconvenient, and that your wealth exists within a system designed to transfer it elsewhere. Nixon didn't just change economic policy in 1971, he changed the nature of money itself, from something real, anchored to gold, to something imaginary, backed by nothing but faith. And we're all still living in the world that decision created. The gold window closed on August 15th, 1971. It was supposed to be temporary. It's been 53 years. And every attempt to understand modern inflation, debt, financial crises, and wealth inequality has to start with understanding what Nixon did that Sunday evening. History isn't over. The pattern continues. And this time, you know how it works.